Recently, we experienced the Liberation Day, where the Trump tariffs hit hard across the world. And it seems that many people in the U.S. were concerned about how these Trump tariffs would affect inflation and affect the stock market. And so far, the U.S. markets are down, but why is the European market up? And why is the Chinese market up? And why are all these overseas markets up? We'll get into that over this next few slides here. But first of all, what I'd like you to do, since you enjoy these videos so much, is put your thumbs up, subscribe to the channel. It helps us a lot, and share with your friends, and we'll get right into it. Through the end of March, the Eurozone's up about 14%, and China is up 16%, while at the same time, the U.S. is down. And so many people have been concerned about inflation and all these other things. But it looks like one of the reasons that the U.S. is down while these other countries are up is because the dollar has been getting a little bit weaker. So in November, there's a research firm called Hudson Bay Capital, and they released a 41-page report. And in that report, they called it A User's Guide to Restructuring the Global Trade System. And the guy who wrote the report has been appointed the chairman of the Economic Council within the Trump administration. And so it's very interesting to look at the report. And they call this thing the Mar-a-Lago Accord. So with the Mar-a-Lago Accord, they're looking at doing several things that may counteract the impact of tariffs, and we'll get into some of those. So this is an example of their report. And in the contents, it's talking about how the tariffs are going to affect things. It's talking about how the currency has been overvalued for quite a long time. Talking about reducing the impact of the currency so that the dollar gets devalued versus where it is now, and how that may cause volatility in the markets. And so Trump appointed the guy who wrote this report as the chairman of his Economic Council. And he talks about a few things in the report. The dollar's been strong, and when the dollar's strong, imports come in very readily because everything's cheaper that's being imported to the U.S. So we get a lot of cheap stuff when the dollar's strong. It also doesn't cost a lot for us to travel overseas. So if you're traveling to Europe, if you're traveling to South America, if you're traveling to Asia, the dollar goes a long way. If we're trying to export stuff to other countries, it isn't so good that the dollar goes a long way. We want the dollar to be weaker so people want our stuff. So if people want our stuff, then that's better for jobs here in the U.S. We're good at spending money. We got to be good at investing money and producing things. So a lot of people say, these Keynesian economists are talking about how it's better that we consume a lot. And if you think about it, we want to be producing a lot. We want to be more productive than the rest of the world. We don't want to be the consumer for the rest of the world. We want to be more productive than the rest of the world. So one thing that we went through in 2022 was we had a supply shortage. And because we're consuming everybody else's stuff, when we have a supply shortage, we're trying to bring over supplies from all over the world. That's not so good when you can't get stuff in from all over the world. If we're able to produce our own stuff, or if we're self-sufficient, we'll be much better off. Right now, we don't produce our own stuff. Manufacturing has gone all over the world, and we don't produce that much here in the U.S. So we're wanting to reshore a lot of these jobs, reshore a lot of the manufacturing here to the U.S., so we produce our own stuff. And this report talks about how they can get to that, where we're able to produce our own stuff, and we're actually able to reduce the value of the dollar in order to make it happen. The dollar's been pretty expensive. And if it stays just as expensive as it has been, these tariffs are going to probably be inflationary. And it's going to result in more expensive consumer goods. That'll rebalance a little bit over time as imports get more expensive relative to the domestic stuff. And as trade rebalancing away from tariff goods occur, the Treasury is going to raise less revenue. But if we're able to get the dollar where it's less expensive, that'll be good for people coming to the U.S. They'll be able to spend money in the U.S. and they'll say, wow, the U.S. is great. Not everything's so expensive here. And we'll have some other benefits for things that we're sending overseas. It won't be as inflationary with the tariffs. Things will be paid for by the tariff nation via reduced purchasing power and the weaker currency. It will have less effect on trade flows. as the import prices don't increase and regulatory reform offsets the currency effects on the exports. And the Treasury will actually raise more revenue. So a weaker dollar does wonders for our manufacturing base and for increasing revenues of the country overall. So what we want to do is we want to be increasing these tariffs to make things fairer between the countries, fair trade, and bring jobs back to the U.S., onshore jobs to the U.S. as we reduce the effects of the currency. Our currency has been super strong. We don't want to be so strong, so we can send our stuff overseas and people will enjoy getting our made in America goods. Some of these pundits believe that Trump is overly excited about getting jobs back to the U.S. He's focused way too much on the manufacturing sector. But right now, about 86% of all the jobs in the U.S. are in the service sector. And as was seen in 2022, when we have a supply chain shortage, it sends waves of nastiness throughout the economy when we can't get our stuff. And so when we can't get our stuff because it's all made overseas, why not look to make more of our stuff here in the U.S.? And that's what we're looking to do by bringing more jobs here to the U.S. in the manufacturing sector. So this guy is Stephen Moran. He's the new chairman of the Council of Economic Advisors for the Trump administration. He's the one that wrote the Mar-a-Lago Accord. And you can also see here how the service sector is such a big piece of the U.S. economy. It's grown and grown and grown over time, so that services have pushed out all the manufacturing jobs. And what we're looking to do is bring more manufacturing jobs back here to the U.S. So if we have these supply chain shortages, that we're not at the mercy of countries like Canada and Japan and Mexico and Russia to provide the things we need, especially if things aren't so great with those countries and we might be going to war with them. We don't want to go to war with them, but if we do, we want to be able to supply our own troops with our own stuff. So how are we going to get the dollar weaker? Sometimes this happens just by lowering interest rates. As we lower our interest rates, there's less demand for our bonds. One other thing that we're looking at is establishing a sovereign wealth fund and using the sovereign wealth fund to buy overseas assets. As we buy overseas assets, we raise the price of overseas assets. And as we raise the price of overseas assets versus the U.S. dollar, that can also weaken the dollar. So there's two levers that we can look at: lowering interest rates and buying up overseas assets. And I would say that we're going to use both levers going forward to help weaken the dollar so that things are cheaper for people buying our stuff overseas. Now, President Trump is clearly aiming to upend the global trading system and is moving full speed ahead on this one side of this thesis for the Mar-a-Lago Accord, and that's through all these tariffs. What he does on the other side can be anyone's guess, but it looks like we're moving toward getting the dollar weaker, and a lot of people are already looking to be selling a lot of U.S. assets and buy overseas assets, especially Euro assets, because if you look at it, the other currencies that you could be buying are the euro dollar and gold. And guess what's been happening? Gold's been going through the roof, and the Eurozone countries have been doing very well so far this year. The average gain in the Euro country is about 14% in the asset markets. So a weaker dollar will be good for jobs in the U.S. It's not going to be so good for the asset markets in the U.S. So owning the Magnificent Seven probably isn't going to be so good to own as we weaken the dollar. Owning things in the U.S. stock market isn't going to be quite as good as owning things in Australia, or owning things in South America, or owning things in Europe, or owning things in Asia. So all these other places where they've got other currencies other than the dollar are probably going to do better than things that are dollar denominated. So we want to stay away from the dollar denominated things. Look at gold, look at things in the Eurozone, look at things overseas, and those things are probably going to do better going forward. So in the Mar-a-Lago Accord paper, Moran laid out that the currency question could rebound in America's favor on a variety of fronts, from the national debt. When the dollar is weaker, we're paying back our debt with a devalued currency, so that could be good, to national security agreements and what have you. So the goal is to ensure the dollar remains as the supreme power in the world. It's the primary currency of the world, and we want to have that as a reserve currency. But an overvalued dollar isn't so good. And the U.S., he argued, could convince other countries to help with the devaluation in exchange for security guarantees or in exchange for dropping some tariffs. And that could be a win-win for a lot of these countries in helping us devalue the dollar so that we could sell more overseas and pay back debt at a lesser price. So we've seen this play out before. The last time the dollar was this strong was in the early 2000s. Coming out of the dot-com boom, we had a super strong dollar. And that super strong dollar headed into the 2000s, and we needed to do something to weaken the dollar. And guess what? We did it. The dollar got weaker throughout the 2000s. But guess what a lot of people refer to the 2000s as? They refer to it as the lost decade. And that lost decade was a lost decade for those that invest solely in U.S. markets. So we want to make sure that we don't invest solely in U.S. markets. Look at what happened during that decade from the 2000s through 2010. The dollar was getting weaker and weaker and weaker. That was really good for us selling our stuff overseas, but not so good for the U.S. markets. The dollar has gotten stronger since then for the last 15 years, and that's not been as good for selling our stuff overseas, but been really good for the U.S. markets. So we want to be invested in foreign markets when the dollar is getting weaker, and invested in U.S. markets when the dollar is getting stronger. So one of these views is that, and this article goes on to say, my view is that the country on which we're imposing tariffs ultimately pays those tariffs as opposed to having any negative economic consequence on the United States. And so Trump likes the promise to keep aloft the mighty U.S. dollar and maintain its status as the global reserve currency. We just don't want it to be quite as overvalued as it's been over the last few years. So looking back again at the early 2000s, this chart here shows the early 2000s and what did the best in the early 2000s going through to 2007, 8, and 9. Early on, commodities did great. And that's what we're probably going to see again. As these tariffs get kicking in, commodity prices are probably going to go up. It wasn't so good for smaller companies right off the bat. It definitely wasn't so good for the biggest, most popular companies. And so the Magnificent Seven is probably not going to do very well. And AI stocks are probably not going to do that great. But it can be really good for commodities and maybe real estate and what have you. Later on, as this continues, commodities still do well. Smaller companies do well as deregulation filters through, so smaller companies will do well. The NASDAQ and U.S. stocks in general are probably not going to do that well. But look at what happens with emerging markets. As the U.S. dollar continues to get weaker, emerging markets look that much more attractive. They're already cheap now. You're buying them when they're cheap now. You can definitely buy things cheap now. You can buy things cheap in the Eurozone also. So Eurozone countries, their companies look really cheap. Chinese companies look really cheap. South Korean companies look really cheap. South American companies look really cheap. All these companies look really cheap overseas. And as the dollar gets weaker, these things will be, a lot more investment in these companies will be that much more encouraged, and the countries will be that much more encouraged as their currencies grow stronger versus the U.S. dollar. So again, since you love these videos so much, please feel free to put your thumbs up, subscribe to the channel, and we'll catch you next time. Stay thirsty for knowledge. Catch up with you later.